All right, let's get right into it. We're looking at a market that is stretched to its absolute limit. I mean, this is a system under so much strain that the very gears of global price discovery are starting to seize up. Today, we're going to dissect the silver market, not just as a precious metal, but as a pressure cooker. And really, the question isn't if it will blow, it's what happens when it does. So, the epicenter of all this pressure, it's the COMEX. That's the New York-based exchange that pretty much sets the global price for silver. And what we're seeing right now is a stress test like never before, where financial claims on physical silver are running headfirst into a stark and rapidly shrinking physical reality. You know, when you see a quote like this, it's not just about normal market swings. Extreme volatility. That's financial speak for a system whose fundamental anchors are coming loose. It's a huge red flag that the core mechanisms that are supposed to keep this market balanced are under severe, and I mean severe, strain. Now, this number right here, this is the flashpoint, 52.63 million ounces. And to be clear, this is not some theoretical paper position that can just be settled with cash. No, these are formal delivery notices. This is a massive, tangible claim for real physical metal, all within a single contract month. So why is that number so critical? Well, it's hitting the market at the exact moment its physical supply buffer is basically evaporating. The heart of this entire situation is a fundamental physical squeeze, and it's being driven by a very clear deficit between actual supply and actual demand. Just look at the data. The COMEX registered inventory, that's the silver specifically set aside and verified as ready for delivery, has plunged by 31% in just a matter of months. Think of this as the market's shock absorber, and it's deflating fast. And here's where the math gets really uncomfortable. The delivery demand for just this one contract month now accounts for over 60% of the entire registered inventory. The margin for error here is razor thin. Any significant new demand could easily push this system right past its breaking point. And what's crucial to understand is that this demand isn't just coming from speculators. Silver's new status as a critical mineral has totally changed the game. It's now absolutely indispensable for the green energy transition, for AI, for everything, and that creates a rigid, non-negotiable industrial demand that simply cannot be settled with cash. Take electric vehicles, for instance. The exponential growth we're seeing there represents a structural, long-term drain on physical supply. Every single EV uses more silver than a standard car, and this demand exists completely outside of what financial markets are doing. It's a one-way street. Okay, so on top of this intense physical squeeze, you have to layer on a set of powerful macro-financial accelerants. The best way to think about these is like pouring gasoline on an already smoldering fire. They are intensifying the pressure on every single part of this system. First up, energy prices. With crude oil pushing past $110 a barrel, concerns about broad-based inflation are coming right back to the forefront. This creates a direct challenge for central banks, and it forces investors to completely rethink how they're going to hedge against that inflation. And the data tells us this isn't just some temporary spike. Core inflation, that's the number that strips out volatile food and energy, it remains stubbornly high. This makes the job of central bankers incredibly difficult because now they're caught between fighting inflation and potentially triggering an economic slowdown. And all of this leads directly to the Federal Reserve. You see, the market was pricing in rate cuts, but this persistent inflation has thrown all of that into doubt. This uncertainty completely changes the opportunity cost of holding a non-yielding asset like silver, and that creates immense volatility as large funds are forced to reposition their portfolios. By the way, if you're finding this analysis valuable, please take a moment to like, share, and subscribe to our channel. That way you won't miss our future updates. Now, let's get into how all these pressures create a deep paradox in how silver is actually priced. This brings us to a fundamental conflict in the market. This growing, widening disconnect between the paper price of silver and the real-world challenge of actually getting your hands on the physical metal. This paradox is what's creating these huge price swings and some pretty significant arbitrage opportunities. You can see this divergence perfectly in the ETF market. The Sprott Physical Silver Trust, which guarantees that it holds allocated physical metal, consistently trades at a premium. What does that tell you? It signals that sophisticated investors are willing to pay more for the certainty of physical ownership, which is really a vote of no confidence in the paper market's ability to deliver. And this isn't just a Western thing. A huge price premium, we're talking $8 to $13 an ounce, has opened up on the Shanghai Gold Exchange compared to New York. This is a massive signal of where the physical demand is strongest, and it acts like a giant magnet, pulling physical silver out of Western vaults and shipping it east, which only tightens the supply for COLEX delivery even further. So what does this all mean moving forward? Well, when you distill all of this analysis, the current situation really boils down to three core interconnected risks that every single market participant needs to have on their radar right now. The first, and frankly the most significant risk, is a failure of the price discovery mechanism itself. If the COMEX can't fulfill its delivery obligations, this stops being a silver problem. It becomes a crisis of confidence that could cascade into the gold market, into credit markets, and seriously undermine the credibility of all paper-settled commodity exchanges. The second risk is a structural rewiring of the entire supply chain. Industrial users who need silver for their products cannot risk a delivery default. So what are they doing? They're bypassing the financial exchanges entirely to lock in supply directly from the miners. This permanently removes that metal from the financial system, making future squeezes even more likely. And the third risk is the macro environment itself. As long as inflation stays hot and central bank policy is a guessing game, we are going to see violent price swings. Sudden margin hikes can force liquidations, causing prices to collapse even while the physical deficit is getting worse. It creates an incredibly treacherous environment for investors. Which leaves us with this final critical question. For decades, paper contracts traded on financial exchanges have set the price of silver. But as the metal transitions into a non-negotiable, strategic resource that's essential for our entire technological future, can that system possibly hold? The pressure is on.